Central banking conversations have dominated headlines in the last few days, and today is no different. With both the global central bank, which is the Fed, which matters to equity markets at large, and the Indian central bank, the RBI, and the minutes thereof for both not sounding particularly dovish. The question remains whether risk assets have a problem at hand. And that's the talking point amongst many in today's conversation with Mahesh Patil of Aditya Birla Sun Life. We'll ask him whether equity bulls, whether they can fight what is arguably now being spoken about as a central bank call. Would rate sensitives be a volatile pack in 2023? What is the AMC's view on autos and capital goods in the current juncture, wherein most people are constructive on those themes? Can consumer names see a longer time correction, if not a price correction? And is Mahesh Patil himself turning constructive on healthcare? Let's pose all of these questions and more to our guest today. Mahesh, great having you. Thanks for joining in.
Yeah, good morning, Raj. Pleasure, as usual.
So
Yeah.
I'll start off with that key conversation. If there was a central banking put in place during COVID times, there seems to be a central banking call option in place currently. All highs getting sold into. Every time there is excitement, there is conversation around how the central banks are committed to fighting inflation and keeping rates higher for longer. Does this cap upsides for risk assets like equities?
Yeah, so I think in the recent past, we've seen that, the markets rallied a bit, okay, from the lows, okay, on expectations that inflation is indeed coming down. We are seeing kind of peak of interest rates. I mean, that was the general feeling which was there. But I think in the recent few weeks, we have seen that inflation, while it is definitely trajectory is coming down, but it's not likely to come down as fast as one would have expected because some of the inflations, like for example in US, the labor market is still fairly tight. The services inflation is still fairly, it's not coming down as fast as one would have expected. And overall underlying growth is still fairly decent. So I think the central banks are looking now that they need to really get inflationary expectations permanently anchored at lower levels. They don't want to do the mistake of trying to pivot too early, okay, and then inflation again goes up. So I think in this backdrop, I think it looks like you will see probably interest rates remaining higher for longer. I mean, the kind of reversal of the high interest rates is now getting pushed back into the next calendar year, and also to some extent, I think the policy rates, I think the terminal rates where we are looking at, I think they are looking probably 25 to 50 basis higher than what we were looking at, say, around a month back. So I think that is a change in stance from the central banks globally and as well as in RBI. Though I think overall, what it means is that from equity market perspective is that you would see that there has been some kind of a slowdown. Okay, what we've seen in India, specifically in the consumer discretionary side, and with interest rates kind of inching up a bit higher, you could see that recovery could get delayed a bit, and that could weigh down on the overall market recovery what we are looking at. So that, to some extent, caps the upside from a near-term perspective, and the valuations have corrected. I mean, we've seen earnings have caught up over the last 1 year, and valuations have come down. There could be slight moderation in valuations, I think, converging somewhere near the long-term average. We are still slightly expensive, but not too much. So I would say that the market will probably get into a consolidation phase over here. Don't see of a bigger downside here because we're not seeing any major downgrades to earnings. But the whole sentiment of recovery, how soon that will plan out, that is probably getting a bit delayed. So I think market will probably go in for some time correction. It will remain in a kind of a band, and I think that's what I think we'll have to live with the current scenario, what is panning out.
Mahesh, while the micro may still look okay if earnings growth stays stable, could the macro, which has been stable thus far, begin to hurt in that we might actually get to a scenario wherein the RBI, because of the global central bank push, as well as inflation not particularly moderating, stays high on interest rates and growth slows down? Because that will be an issue that we kind of see a repeat of, maybe not a repeat of 2013, but something like that, right? Wherein growth is slowing down and the central bank hikes are happening.
Yeah, so I think an underlying growth is still fairly decent if you look at. It's been a kind of a K-shaped recovery. So There are a few sectors, okay, which are kind of recovering and doing well. There are a few sectors, okay, where we've seen growth getting impacted a bit. And to that extent, I think some of the sectors were more sensitive to interest rates. Okay, we've seen the housing market, for example, real estate market has been doing fairly well still. It's still been a steady kind of a demand which has been there. Execution has been fairly good. But if interest rates go up much higher, we've seen almost 175 basis point increase in the mortgage rates in the last 3 to 4 months. And if that starts to further inch up, then you could see some slowdown over there, is what one can expect. Overall, in the other sectors, like for example, auto, industrial, capex, I don't think that is going to, like for example, the whole spending on infrastructure and capex is not going to material impact because they're long term in nature. Interest rate increase which are happening is probably a phenomena which will not likely to last. I mean, we don't expect rates to remain high for a longer period of time. So I don't think that will get impacted as much. So yeah, there could be a few much impact on discretionary consumption, which I think might see the recovery which we were expecting might get delayed over there, and you could see. I mean, our expectation of GDP growth for next fiscal year has been around 5.75% or so, which I think could get moderately impacted because of a few sectors. But I don't see that another 25 basis point. We are expecting the policy rates in India to go up by another 25 basis point. Would not have such a material impact. Okay, where you would see growth coming down significantly. But clearly, I think in terms of the equity market standpoint, I think any increase or higher interest rates will impact the sentiments and the valuation multiples. I think so. To that extent, the markets can remain a bit subdued at this point in time.
Mesh, individual themes, and you brought out some in your conversations. Just wanted to understand how are you thinking these through. So, rate sensitives. Everybody was constructive on banks, earnings, and earnings growth might still look okay. But if how, but there has been pressure there. Maybe because the sector is over owned as well, and maybe 2022 also saw PSU banks do so well that they are seeing the wrong end of the stick currently. What is your view on financials currently, banks, private and PSUs, as well as NBFCs? How do you see that?
Yes, the banks, I think, currently are still looking. If you look at in terms of earnings growth, we are not seeing any major kind of negative impact. Obviously, the question remains on growth. Credit growth has been fairly good. Next year, as we get into it, whether that remains in the double digits is to be seen. We still believe that it will still be in the low teens kind of a growth, which is not bad. Interest rates remaining slightly higher for longer is not necessarily bad for banks. You've seen the
Yeah.
banks benefit because of the increase in the net interest margins because I mean, the late rates are now linked to the MCLR rate, so that transmission is much faster. And if there is another 25 basis point, you will see that net margins, okay, which have kind of looking to have peaked out by the fourth quarter, could remain higher for a longer period of time. And overall, on the credit cost side, we're not seeing any major challenges. I mean, this time around, I think we've seen that the overall bank, I mean, the corporate balance sheets are in pretty good shape. I mean, except for the Adani issue, which has come up. But overall, if you look at across large corporates, there's been a significant deleveraging which has happened in the last 2 3 years, especially after COVID, and we're not seeing any stress, major stress across any large sector or large corporate. So given that, I think your credit costs will remain fairly benign, and that's the reason why we don't see any negative connotation for the banks, even if interest rates go up a bit. Sentimentally, banks have got impacted recently, as I've said, because of slightly over ownership, which has been there, and normally when there is I mean, sell off, right, from FIs, we see this sector getting impacted. So I think bank still looks good, but again, within that, PSU banks had seen a good rally recently because of re-rating in multiples, and also obviously good set of numbers coming in from the PSU banks, which also will probably continue for this fiscal year. But I think we'll still prefer the private banks. I think PSU banks, we think, will still remain a trade because beyond a point, I think the growth dynamics for PSU banks will be a bit of a struggle. They need to raise capital if they because need to grow. Private banks, I think, will continue to, I think, be a good bet from a long-term perspective. So I think post recent correction, the bank stocks now look fairly attractive, both on a I mean, compared to the historical multiples, and also in terms of the current ROEs and price to book value. Okay, if you look at where they would be, look fairly attractive for us to be constructive on the banking space.
What about NBFCs? There's this whole belief that once the rate trajectory pauses or comes off, NBFCs would be better than banks. That's gotten pushed. So therefore, the excitement around NBFCs, lending NBFCs, gets pushed as well.
So NBFCs again are, yeah, I mean, to much extent dependent in terms of the borrowing rate. Okay, to what extent the cost of funds come down, because they haven't seen that play out. While on the asset side, okay, they've seen the rates kind of go up. So NBFC, I think overall, I mean, it's the combination of your interest rates as well as the growth, because a lot of the NBFCs are also in sectors, okay, where the growth, especially on the consumer side, retail side, the growth has been a factor which is driving the multiples over there. Because normally they would expect NBFCs to grow at a faster pace than the banks, and that's why you would want to play the NBFC, because they are in the niche sectors or in the on the retail side where the credit growth can be stronger. So I think on that front, I would say that the benefit of lower interest rates on the borrowing side is probably getting delayed a bit, and we would have expected the margin improvement for NBFCs to start in the next fiscal year, at least starting from the first quarter. So that gets pushed out a bit. But I think NBFCs will still be more specific in terms of to what extent, which sectors they are catering to, and what is the growth dynamics in those sectors, whether it is in the auto side, whether it is the consumer retail side, or whether it is the uh, unsecured lending, okay, which they're looking at. So I think the segments where they are and what's the outlook for that, I think will drive the performance of the NBFCs, I would guess.
Okay. Maybe just one quick follow up question there before we move on to consumers, because I want to talk to you about that and then about autos. You guys were prescient in that view. But first, the capital market related plays. We know that 10 years out, a lot more people will be using uh, the Indian capital markets in various ways: broking, AMCs, insurance companies, service providers, what have you. The recency bias has crept in, wherein these stocks have gotten punished, almost all of them unequivocally without exception. Is this a theme that is attractive, or would you be on the sidelines currently, if you are indeed present out there in the first place? Any views there?
So we're not too much there on the capital marketplace, okay, because again, that space is also fairly competitive, right? We've seen a lot of new entrant disruptors coming in that space, and difficult to really gauge in terms of how much, who will gain market share and who will do well in that space. Okay, so and again, in that space, we've seen some margin pressures also coming in because it's on the income side. So given that, while the long-term outlook for the sector looks good, because we've seen the whole penetration, okay, of capital markets, and the thing is, India is in a flux, especially after COVID. We have seen that move up quite a bit. So the base has kind of widened a bit. So which looks from a top-down perspective, it looks fairly attractive. But really, for us to play in that segment, we think that there are a few companies which have done exceptionally well over there. But the company landscape is still fairly competitive, and we could
Hmm.
see some margin pressure. So we've not really been as positive on that space. And again, it's more volatile depending on the market condition, right? Because so given that, we've stayed away from that sector, not really had a large exposure there.
Thank you. Thank you for that, Mahesh. Now, you've invoked consumers twice or thrice in this conversation already. I want to understand, urban consumption also has come off. Now, it may have overshot and therefore it's coming back to mean, maybe that. But whatever the reason may be, there is a bit of a pullback there too. What happens to consumer discretionary? There has been a bit of a price correction, a bit of time correction for certain plays as well. Uh, do they continue to see that, or sporadically you might see some moves? I mean, air conditioner companies in because of a hot summer or what have you. How do you look at this whole bucket?
So consumer sector, I think if you look at the discretionary consumption from a long-term perspective, it's still a very good sector. We like that sector because in India, the overall per capita income, okay, as it goes up, I mean, we are at an inflection point around $2,500, and that's a time when we see a lot of spending on discretionary consumption starts to pick up. And over a longer term, we see that discretionary consumption as a percentage of the total consumption, which is around close to around 25-30%, will go up significantly. So that, I think, narrative remains strong for consumer discretionary for the next 3, 5, or 10 year perspective. And good names with good brands, with good products, will continue to gain market share. And again, in some sectors, there is unorganized shift from unorganized to organized, which will continue to drive higher growth for the organized players in that space. So I think that narrative remains intact. And yeah, in the short term, there has been two impacts. One was the increase in the higher commodity prices, which we saw, okay, in the last year, which hurt the margins in the consumer discretionary names. And then there was some amount of slowdown in urban consumption, especially on consumer durables and that sector. So which has a double whammy in terms of getting profits getting downgraded in the sector. And we've seen a decent correction also in some of the stock prices. So I think near term, it's still going to be a slow recovery. We're not seeing any sharp recovery, and with interest rates remaining slightly, because a lot of these consumer discretionary items are also now lending. Okay, is a large part of financing is a large component. Okay, which drives consumption over there. So with interest rates going up, it can impact a bit over there. But I think once things normalize a bit, I think the margin pressures are now easing off as commodity prices have come through. So that, I think, is a positive. So you will see that improvement in the subsequent quarters. Demand pickup also, I think, after some pause recovery, we should expect that to pick up sometime later in this calendar year. So if you're taking a longer medium term view, I think some of the good quality consumer discretionary, it could be a good time to start accumulating them now post the correction, and to play the long term structural growth in the overall consumer discretionary sector, which we remain, which we are positive as one of the long term themes for India.
Okay. Okay. Thanks for that, Mahesh. Last couple of questions. I've heard some of your peer sets start to turn at the margin, start to turn constructive on healthcare uh, and different facets there. What is your view? Are you constructive here?
So in the healthcare, there are two parts to it. One is the domestic. If you look at it, three parts actually we look at it. One is the domestic pharma. The second is the US generic companies which have got large US exports, and third would be the hospitals and the other sector, right? So
Yeah.
we are constructive. We are positive on the domestic pharma, also positive on the healthcare, which is the hospitals, and a sector which is, we think is again a steady. As you've seen, there is a good demand for hospitals. We're still underpenetrated market, organized players, okay, gaining market share over there, and a steady improvement in terms of the overall. If you look at the average uh, rates, okay, for the per hospital bed is also moving up. So that's a good long-term secular story, I think, which one should play out. And the other pharma, if you look at the large pharma players, I think the US market is still fairly competitive. US generic space, we're still seeing
Hmm.
pricing pressure over there, and I think the US FDA has now again further increased. Okay, after the COVID, we've seen plant inspections coming up, so the risk about warning letters and other observations coming in for the plants is now increasing, which poses some company specific risk, okay, in the pharmaceutical space. And so I think here, I think companies which are more getting into, say, the specialty this thing, products, and investing in that rather than the generic space, I think are companies, I think, which one would want to play out, because the broader US generics market is getting very competitive and margin pressures are there. So I think the broader pharma space will be more company specific, depending on which segments of the market you are targeting, and what kind of a focus you have, whether larger focus on domestic side or on the US side, I think, which will really drive the outlook in the stocks.
Great. Mahesh, my final question. Where is it that you are most constructive on from a risk reward perspective? You guys were uh, fairly prescient in your opinion around autos, which we spoke about as a key theme back in Jan 2021, if I'm not wrong, or 22, sorry. And it did really well. People are constructive on that even now. So some of those things have worked out beautifully. from at the current juncture, where is it that you're most constructive on?
So I think the risk reward is kind of fairly well balanced across space, but I think we still remain constructive on the banks. I think the post the correction, I think the outlook there and the we don't see any material dent to that. I think that still remains our a view where we could see a decent performance at least from our next 1 year perspective. Uh, Apart from that, the broader themes which we would like to play out are, I mean, overall, even IT sector for that matter, right? Digital, we think, is a good long-term theme. I think the recent concerns about US slowdown and which have hurt some of these IT companies, I think is getting more or less priced in. Pricing pressure, which was there because of the increase in the manpower cost or the labor cost, that is also kind of easing off. And yeah, while the growth will slow down, but we think that the sector has a good visibility in terms of longer term growth and good cash flows. So that's a sector which looks good in this current context. Autos also, I think, are looking fairly good in terms of the broader recovery. What we are looking at, and apart from the defensive, like say utilities, for example, are are fine. Okay, where there is a steady kind of I mean, overall the power sector, if you look at in India, the demand has been fairly steady, really increasing, and some of these companies offer good dividend yield. I think in this market, I think that provides a good kind of support. So selectively, I think that sector also is something which we will favor. And apart from that, I would say I mean, the healthcare sector, the hospitals and other sector, which are a good long-term growth drivers, which one can look at. So I'd say banking, autos, even industrial and capital goods sector for that matter. Okay, though they're expensive, but I think we have seen capex slowly picking up. Private sector capex is still early days, but I think we've seen the capacity utilization in a few sectors kind of going up, and that could be with the government focus on infrastructure and the whole the PLI schemes, okay, which are getting implemented. So I think manufacturing and that will drive industrial. So I think industrials would also be a sector with a longer term view where we would see good growth coming in.
Great. Mahesh, always lovely talking to you. Thank you for giving us your overarching thoughts on the markets and some of the themes that you guys are constructive on.
Thank you.
And viewers, thanks for tuning into this leg of the Talking Point.